profit volume ratio is given. Divide contribution by profit volume ratio, you will get sales. Variable cost ratio is an important element as well. Like contribution to sales ratio, variable cost ratio is simply total variable cost divided by sales, right? So if PV ratio is contribution to sales, so if PV ratio is contribution to sales, that's contribution divided by sales into 100 is PV ratio. Let's say in a given case, if PV ratio is 30%, that means rest of the 70% is what? It's only variable cost. Contribution is sales minus variable cost. This is what is contribution. Sales minus variable cost is contribution, and that contribution to sales ratio is 30%, which means variable cost ratio is 100 minus PV ratio. This is important to keep in mind because your problems in your questions in examinations will perhaps give you variable cost ratio. So if variable cost ratio is given using the same equation, we can do the ulta, right? We can do the reverse. 100 minus variable cost ratio is what? PV ratio. PV ratio is given. 100 minus PV ratio we can use to find variable cost. So these are important techniques that you need to keep in mind that will help you to solve the problems. Let's take an example. Calculate break-even point and sales to earn profit of 20,000 from the given information. What is given? Fixed cost is given. Variable cost per unit is given. Selling price per unit is given. All what we have is information. Total fixed cost, variable cost per unit, selling price per unit. What we need to find out is break-even point and sales to earn profit of 20,000. We know break-even point is sales minus selling price minus variable cost, that is contribution. Fixed cost divided by contribution is break-even point, right? Let's first find that out. Contribution per unit is 30 minus 15, 15. Break-even point is fixed cost minus divided by contribution, that is 10,000 units. So we found break-even point in the equation, which was very easy. Let's go to find how to make profit of 20,000. We know the fixed cost given is 1,50,000. Total contribution needed for 20,000 profit, we need to add that 20,000 to fixed cost, because if we only recover this much, there is no profit, no loss, like we said earlier. We now need 20,000 profit. So we simply add 1,50,000 with 20,000. We need a total contribution of 1,70,000. Contribution per unit is 15. So how many units do we need to make 20,000 profit? 1,70,000 divided by 15 is 11,333 units we need. In value, if we were to find this in value, 1,70,000 divided by 15 into 30, which is a sale price. So 3,40,000 is the total sales target one need to achieve at 30 rupees per price for making 20,000 rupees profit. Let me repeat. Fixed cost given is 1,50,000. Total contribution needed for 20,000 profit is fixed cost plus that contribution that we need, additional profit we need, right? We remember we have studied in the previous slide that our contribution is equal to our one of our equation was what? Contribution is equal to fixed cost plus profit. Fixed cost plus profit was our contribution, and we understood that relationship very well. So now we can solve this problem very easily, right? So if you look at how did that relationship come in picture, because we know the contribution per unit, because we know the fixed cost on like 50,000, and then there is an ask of making 20,000 profit. We know total contribution we make is fixed cost plus profit we need. So we did exactly reverse of that. We added contribution we needed, additional contribution needed for making profit, the fixed cost. and then we arrived at 1,70,000. And for 1,70,000 number of units needed, if BEP unit is, if the sales unit volume is what somebody has asked, we will give them the volume. But if they are asking value, then we are giving them the value, right? 1,70,000 divided by 15 to 30, we get 3,40,000 as the sales needed to be achieved in order to make profit of 20,000. Take a look at how we solve this problem in summary. This is just a summary so that you understand it completely. We were asked to compute break-even point and the sales to earn profit of 20,000. Fixed cost was 1,50,000. Variable cost of 15 per unit. Sales price per unit was 30. This was given in next question. First, we figured out the contribution. 30 minus 15 is equal to 15. Then we figured out the break-even point. 1,50,000 divided by 15 is equal to 10,000 units. Then we figured out what is the total contribution we need for making that profit of 20,000. And then we figured out the number of units we need for making that kind of profit, and in terms of value by multiplying that with sales price. Let's move on to a profit volume, real usage of profit volume ratio. This is again picked up from your study material only. You can work out more complicated sums from different textbooks and then write back to us if there are specific questions and clarifications you need. Any support that you need, please feel free to contact us and we will further give you clarifications. And if you want one-on-one sessions, please request for that in our contact us page. We will be happy to provide that also. If you are limited, sales of 2013 is given, 2014 is not given. Profit volume ratio is given in both the years. Margin of safety is given for both the years. So what are the information we have? Any problems in examination when you try to solve, you need to read the question with a fresh mind. Okay? Don't get hassled. Take a look at what is the information given. There is a structured way of answering any examination questions that will help you to score higher marks. We have been given in 2013 total sales, 2014 not there. Profit volume ratio given both the years. Margin of safety given both the years. So this much of information we have. Just think, with this much of information, what all we can produce. We know how this 50% is arrived at, right? We know how the 50% is arrived. This is contribution divided by sales, which means sales is already there. C divided by S is equal to this. So we have this 50% is equal to C divided by 8 lakhs. C we need to find out how easy it is. Think about it. Margin of safety is given. That is 40%. That means margin of safety is what? Sales after break-even point, right? Sales minus break-even point is equal to margin of safety, which means 40% of 8 lakhs is equal to margin of safety, right? 40% of 8 lakhs is 3,20,000. If 3,20,000 is margin of safety, how much is your break-even point here? 8 lakh minus 3,20,000. Simple, right? How easy it is. So we can find break-even point here also. Margin of safety is here. Break-even point we can find here how? Because you have 37.5% of profit volume ratio. With profit volume ratio, I'll reserve that for some time because it needs some help of numbers to help you identify this. The trick here is how do we get to the EP and sales figure here. I'm hoping this part is very clear for you, right? Profit volume ratio we have reconciled. We know how to figure out the contribution. We know how to figure out the break-even point. Let's see what are the additional information that are given. There has been substantial savings in fixed cost in the year 2014 due to the restructuring process. The company could maintain its sales quantity level of 2013-2014 by reducing selling price. That means the volume has not changed. The company has maintained sales quantity level as it is in 2014. So the total volume remains same. Clear? If the total volume remains same, what does it mean? Variable cost remains the same. Isn't it? your variable cost does not change unless the volume changes. So if we find out variable cost here, we can take variable cost here also because the volume is same. Let's take a look at if we can find variable cost here. Take your paper and pen and see. If you are able to find profit volume ratio is 50%, contribution to sales. So contribution is how much? 50% of 8 lakhs. That is 4 lakh, right? 4 lakh is your contribution. Margin of safety is 3,20,000. Correct? If contribution is 4 lakh, margin of safety is 3,20,000. We figured out the break-even point also. With all this, can we find out what was the variable cost in 2013? Because we need to find that out. What is the variable cost in 2013? Once we find that out, we know the same variable cost applies for 2014 also. Keep it in your mind. Take a look at what are they asked to find. Sales for 2014 in value. Fixed cost for 2014 in value. 2014. Break-even sales for 2014 in value. These three were to find out. How do we solve this? 2013 PV ratio, they have given 20%. Variable cost ratio, therefore, is what? Remember the equation we studied. 100 minus PV ratio. That is 100 minus 50%. So 50% is the variable cost ratio. Sales is equal to 8 lakhs. So variable cost will be 50% of sales. That is 50% of 8 lakhs. So total variable cost is what? 4 lakh. Remember what we discussed here. If we find variable cost here, variable cost will be same in 2014. Why? Because the company could maintain sales quantity level as the same. So we cracked it, right? Because 2013 fixed PV ratio was 50%. Variable cost ratio is 100 minus PV ratio, 100 minus contribution. 100 minus contribution to sales ratio is a variable cost ratio, which is 50%. Because it is 50%, sales 8 lakhs, 8 lakhs 50% applied, 4 lakh is your variable cost, total variable cost. If someone is thinking, how did this come? We referred this earlier in our session that PV ratio is the contribution margin. Contribution is arrived at after reducing variable cost. So if 100 rupees is your sales price, variable cost is 30 rupees. 60 rupees is your contribution. 60% is your contribution to sales ratio. Therefore, how much is your variable cost ratio? 30%, right? It's the same equation that we have used here. If your contribution to sales ratio given is 50%, naturally, your contribution is arrived at only after reducing variable cost. Therefore, your variable cost ratio should be 100 minus 50%. So, in this case, 100 minus 50% gives us 50% as the variable cost ratio. And we have applied the same variable cost ratio to arrive at the total variable cost. Next part of the problem. In 2013, sorry, in 2014, there's a mistake here. It's 2014, the PV ratio given is 37.5%. Variable cost ratio is 100 minus, here also it will be the same, right? Variable cost ratio, because 37.5% is the PV ratio. Variable cost ratio will be 100 minus PV ratio, which is 100 minus 37.5, 62.5%. You know what? We have the variable cost in total, right? Which is the variable cost? Variable cost does not change as the volume remains the same as of 2013. So variable cost is equal to 4 lakh. 4 lakh is 62.5% of what? 4 lakh of 62.5% of what? Of sales, right? Variable cost ratio after contribution is equal to 62.5%. Contribution is equal to sales minus variable cost. So variable cost ratio plus PV ratio will give us what? Sales, isn't it? It's 100%. 100% is sales. So 62.5% is 4 lakh in this case. Therefore, sales will be 4 lakh divided by 62.5%, which is 6,40,000. Remember the fundamental equations. Sales minus variable cost is equal to contribution. Contribution plus variable cost is equal to sales. PV ratio is equal to contribution divided by sales. Contribution and contribution ratio given, you can find variable cost ratio. Once the variable cost ratio is found, given with the variable cost amount, you can find sales. Once the sales is found, once the variable cost is found, you can find with the variable cost ratio easily the sales figure. This is what we have done here, right? So sales is 6,40,000. What is next we were to find? Break-even point. Sales is 40,000, 6,40,000. And the PV ratio is 37.5%. Given in this we found, this was given in the question. Then the contribution is equal to 37.5% into 6,40,000 is equal to 2,40,000. Right? Margin of safety is already given in the question, which is 21.875%, which means margin of safety is 1,40,000 applied onto the sales. Margin of safety number into the total sales value. That is what is given as margin of safety in value. So the margin of safety ratio is given. We are using margin of safety ratio. This is on sales, right? Margin of safety is 21.875% on sales. We already found the sales here. We multiplied that margin of safety ratio to find out what is the value of margin of safety in the 2014 year. That is 1,50,000. Break-even sales is equal to sales minus margin of safety. Naturally, right? The margin of safety itself is after break-even sales. So 6,40,000 minus 1,40,000 will give us the break-even sales for 2014. This is clear. I am hoping this is clear because we have earlier discussed the margin of safety concept. Break-even sales is equal to sales minus margin of safety. 6,40,000 minus 1,40,000